You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionFit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
And hello, everybody, and welcome to the Option Block. This is Andrew Giovinazzi, your, we'll just call it temporary host today. While Mark is out, let's guess, everybody, let's take a poll. Where is Mr. Longo today? Oh, at another leafy climate, working. Working maybe with a cocktail or a frosty beverage in hand, shaking hands, getting some sunshine, and probably playing multiple rounds of golf. While Alex and I today are going to hold down the fort on the Option Block. And with that, a quick introduction, I'd like you to meet my co-host, Alex, the Viceroy and man of many hats, Jacobson. Welcome to the show, Alex.
Thanks, Andrew. And I'll just do a quick recap, but I want to take a minute. I know I've done this on the show already. First, I want to do a shout out to Uncle Mike. Uncle Mike had oral surgery, had a bone graft, and is off the show today. I also want to do a shout out to a fellow I used to work with. I know everybody in the industry knows him, Jim Bittman. I mentioned Jim, who was a senior instructor, is a senior instructor at CBO's Options Institute. Jim suffered an unfortunate stroke a few weeks back, and the good news side to the story is he's still rehabbing, but he has gone home, and he is recovering. And that's exciting news because the prognosis is very, very favorable. But Jimmy, hopefully you listened to the Insider broadcast, and we're all wishing you well, and we're glad you're home. That's a sign of progress, and wishing you a speedy return to the SIBO so you can educate thousands of public customers and help generate appetite and interest for all of us. Reverting to the market was up today. Just kind of a quick recap. S&P closing over 2030, up over 7 points. And the question we always raise is what was going on at Options Express? And trading today was dominated by a handful of names. Qualcomm and Regeneron, which were earnings and news related, but Alibaba, the recent IPO, taking out the 111 level today. Interesting the way the extraordinary performance that stock has had. The other things lighting up the tape today were, again, the oils and oil-related issues and the commodity itself were active here today. The other big news today was Tesla trading in an $18 range today with surprisingly good earnings, probably in the last year or so, one of the fastest growing option volume option names. But an interesting day in Tesla. What was your day like, Andrew?
Before I talk even about my day, I guess we should, now that we've all made our hellos, we should get to the trading block, which I think your topic was great for the trading block, Alex. I have one story about Jim Bittman. When I was a young, we went to the SIBO, to take the exam, and I took the market maker class, and Jim taught it. This was 24 years ago, which seems like yesterday, but yet it was 24 years ago. And there was about 18 students in the class for the market maker test. And he's like, the last time I saw this many people in candidates in a market maker class, we had the crash of '87. So of course, all of the new candidates are like, oh man, that's a bad omen, man. That's a bad sign. And then of course we realized afterward that Jim said that to every class that came in as a market maker candidate. That was his little way of giving you a little push out the door and making sure you. He was basically messing with his students. So Jim has a good sense of humor, I should say. So that was my little story about Jim Bittman way back. And he was bald then, and he's bald now, by the way. He had no hair way back then, and he still has no hair.
And I was chubby then, and I'm still chubby now.
We don't change very much. All right, okay. And with that historical insight into our good friend, Mr. Jim Bittman, we are going to roll into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody, and welcome to the trading block. Here's where we give a little rundown on what's happening. Alex was kind enough to let us know what was going on from the OX side. For myself in the option pit, we actually had a hard time finding things to do today. Mostly, we're all sitting waiting for volatility to break to lower levels. VIX closed 1391 today, down 25 cents. Remember, you've got the new VIX has the two weekly options in it, and VIX-MO, VIX-MO, I guess it's kind of like rhymes with Mo Money or something like that, but VIX-MO, as in the old VIX monthly, is actually trading at a premium to the new VIX, and I believe the VIX-MO ticker right now is trading 1441 where it closed, and the new VIX is trading 1391. So indeed, we had questions about this over the last few weeks. What will moving to those front two weeklies do? And what you have is when you have that contango in the options, meaning those front month volatilities start to sag faster, that's pulling the VIX down just a little bit lower than using the old monthly setup that the SIBO first had. So we have a 1391 new VIX now, but the VIX options and futures are still trading on VIX-MO, which is trading around 1442. So volatility came in today a little bit. So we had Draghi, I guess, Alex, because I guess you are our macro guy. Well, I guess you don't have Tucson to talk with, but what do you think the Draghi comments had on the market? Was it a surprise, or is it just kind of more of the same coming out of Europe trying to bail themselves out of their hole?
Yeah, I think the expectation is Draghi has said he's going to do anything it takes to prop that up, but I think the story is getting a little old. I think they saw the success that the Fed had here with quantitative easing, and I do have to tell you, anytime I say the Fed was successful with quantitative easing, the next day I get stacks of emails from people calling me a Yellen lover. But I think they look at what happened here, and I think they stand ready to to provide help. The challenge in Europe, though, I think is I fear that quantitative easing there. First of all, rates are already nothing, so there isn't anywhere to go. The southern part of Europe, those economies, I think if you threw money at them, you're pushing on a string. I don't think it will help. I also think, being the macro guy, that Merkel has been overly conservative here, and German exports are already showing weakness, and some of the big German exports, the autos, the last couple weeks have seen significant slowness. So I think there's more difficulty ahead in the European Union, and I think in a lot of ways that makes us right now the shining star of world economies, and I think that bodes well for American stocks. I mean, Mike and I always banter about what's going on with our 10-year, and obviously 6-7 weeks ago, when the market had extreme volatility, our 10-year rallied on price down to below the 2 level, which I think took everybody by surprise. We're back up around 240 now. But look at the German 10-year, under 0.8 of a point on the 10-year. I mean, money is free. Apple's going to float this long bond in Europe at under a point, and it's going to get sucked up because there isn't a lot of opportunity out there. So I think Europe is still going to be a soft point. And I think it's something that every once in a while is going to rock us lower back here in the United States.
So it seems like that's the story that sort of reoccurs, where Draghi says he's going to do something. Ultimately, there's not much he can do. But also, do you feel like there's not much he wants to do? He wants to get some economies to sort of loosen up some of all the labor rules and bureaucracy and all that crap that makes Europe sort of, let's just not call it the growth hub for business that, let's say, Asia has become over the last, decade at least, where Asian economies relatively, I mean, China is a quote unquote a communist country, but it can grow. So they must be doing something as far as sort of letting business fly somehow.
Yeah, and to your point, much of Europe, with the exception of the Germans, aren't really known as, I want to find the right term, but I'll just call them vigorous entrepreneurs. And the southern part of Europe clearly has problems. And to your point, Andrew, I think some of the rhetoric is he needs to see some economic reform. And that's tough stuff. I mean, there's still, the Scandinavian countries, you've got a huge social welfare system and huge taxes, but decent productivity. Plus they have energy. The North Sea oil is a big plus. But if you get down to Greece, Italy, Portugal, and Spain, there's clearly labor issues there that are an obstacle. To your point, they're not known as being as entrepreneurial as most of the Asian economies. And structurally, and again, to your point, Andrew, they're going to need to be some changes made there. And that change isn't easy, and Draghi can talk it around all he wants. There's going to be more pain before there's going to be change. And unclear at this point how much of that pain is going to be. That German long bond, the Japanese are at 0.47% for their 10-year. The Germans are at about 0.8. Is Europe going to have sort of the same kind of stagnant economy that the Japanese have had? And the answer is, unless they can do something about it, all the central bank action isn't going to help much.
Yeah, I think one thing that I think was notable that happened last year, and basically in the teeth of the year of our big rally, is we had two of like some of the more quote unquote frightening incidents, right? We had the sequester. Everybody was freaking out about that. And then we had the so-called fiscal cliff where they had to come up with a budget deal. And both of those deals resulted in the government spending a lot less money than they would have, yet market rallied to all-time highs. We still had GDP growth, and they kind of did sort of the hard structural stuff. And I believe that was the last thing I think Congress and the president sort of signed and agreed on because, of course, the elections were coming up. But you can see that those structural reforms, trying to get the government slightly out of everybody's pocket, at least in the U.S., it looks like that was the big difference, I think, between the two, like let's say these three major economies, the Euro bloc, the U.S., and Japan. And it looks like after we had that rally last week, you guys probably covered it on Monday, but with the Japanese central bank essentially printing money to buy stock, at some point, it feels like there's a limit on all this QE stuff. Where after a while, I don't really know how much good it's going to do that, how much it's going to do. I guess time will only tell, and we'll watch it. But I think that was where the volatility is going to come for our market. A lot of what we just had in mid-October, that vol came from some European worries, and the vol spiked sharply, quickly, and just as fast they went away. And I think that, I agree with you, Alex, the vol in our marketplace is going to come from the upheavals overseas. But, overall, the U.S., hopefully, if they kind of stay on the trajectory they are, should be able to keep chugging along anyway. And then Tusa and his bullishness will be vindicated, although I can't disagree with him. All right. I think that will do it for the trading block. And we'll roll right into, we're going to put on our fedoras, grab our Sherlock Holmes type pipes. We do a lot of pipe smoking, I think, on the option block. And we will roll into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Hey, everybody, and welcome to the Odd Block. That funky beat means we are going to look at the unusual, strange, and just plain odd activity that funds and traders with very large accounts sometimes do and put up, even leaving us scratching our heads every once in a while. The first one we have today, and I'm gonna put this with a caveat. I think they took this volume down off the tape. I was just looking at this here at the close, but I'm going to tell it to you anyway because this is a big boo-boo if it was, okay? The ticker symbol is XOP, closed 59.25, up about 53 cents today. It's the SPDR S&P Oil and Gas Explore ETF. That name had a high this year of around 83 and a low of 52. So a huge range for an ETF of this size, mostly with the price of oil going down, and and all I can say is people are freaking out. I think this was part of what's helped send the S&P 500 down. Is a big chunk of the S&P 500 was getting sold off with the price of oil, and that helped sort of precipitate what we had in October. Usually when you have 1, 2, 3 events happen at once, the market starts to freak out. So here we have XOP, volatility again, very high. And what did we see? What did I see go up? Okay. Now, Alex, I know you're there. Just listen. 250,000 January 2015 63 calls went up, with 375,000 January 65 calls. Okay. That's somewhere just short. Actually, it's just over 600,000 contracts in one name. And at the time, it looked like a stupid, right? Buying calls, again, close to the offer on both sides. The 63 calls trading for around $1.84, and the 65s trading on splits for around 127.5. And they came off the tape, it looks like now, just at the end of the day. But I ask you, how do you put up, Alex, I know you work at OX, you might be, how do you put up 600,000 contracts and then you take it down because it was a boo-boo? They wanted a do-over. I don't know if you're here, Alex, but
yeah, I'm here. I have no sense of. So you say to yourself the obvious things. Was it a 300,000 trade with an error? I just don't know. I'd have to dig deeper to get some sense of it. But right now, it's a DK on my side.
Yeah, it's just I've just never seen that kind of size go up and then come off the tape. I know I've seen mistakes before, but you'd think you would have your ducks in a line when you're just trading 200 to 600,000 contracts. That's just me. Of course, that's why we call it the odd block. Next on the list is shares of Geron Corp, ticker symbol GERN. I know Longo loves this one because Geron and GERN are very close to, or kind of sound alike and look alike for him, so the ticker matches the name, and it does not confuse his overworked and overstressed head over at the Options Insider Radio Network. However, Geron today was down 18 cents to 245. The name is trading at the bottom of its 52-week range, somewhere poking, I think the lows of the year around $1.50, the highs around $7.50. What did we see? Okay, we had paper trading 15,000, GERN, or we'll just call it GERN, right? Geron Nove 2.5 puts for 25 cents. ADV in the name is about 1,345 contracts, which for a little junky stock here on the odd block, that's some volume. Open interest on the strike, though, this is where the story is, was 15,294 contracts. So as I see these puts going up for 25 cents, I'm thinking it's probably a close. And I go, I've seen this trade before, and so I have, where this customer sold these puts earlier in the week. We'll be profiling this on the Options Insider Unusual Activity website. But the trader sold these for 15 cents only a few days ago, November 4th. Actually, today's the 6th, so 2 days ago. So they sold them for 15 cents, and here they are back, buying them back for 25. So for whatever reason, they saw the error of their ways, and clearly they did not want to take the stock. So I would say, listeners, for all of you that sell puts, I only sell puts if I can handle taking the stock. And I guess in this case, they got a little drawdown in the name, and that was enough for them, and the customer closed. So, they lost a dime 15,000 times. It's not the worst day somebody's had, but it's certainly not a very good day for this GRN trader. Now, I've seen paper like this, a lot of this going up where I think it feels like the same type of seller where they're kind of going just out of the money or near the money and selling blocks of puts for 10 to 15 cents. I don't know how much of a winning strategy that is. It's not something I really like to do unless I want to own the stock. So again, that is, I would just say, a tough way to make money overall. You don't have a whole lot of room to be wrong with those particular strategies. Okay, so moving on. Ticker symbol EDMC. This is shares of Education Management Corp, and this is an odd block special. Alex will love this. The stock is up 11 cents to 81 cents today. So it is having a banner day, up around 15%. EDMC, shockingly enough, is near the bottom of the 52-week range. And this is a stock that it's one of those education companies. They're a provider of post-secondary education in North America. They have 150,000 enrolled students as of October 2011. So I guess they have a lot less now. I do know they have around 10,000 employees. So it's a company that it's still functioning. However, their equity is not really functioning very well, at least today. So earnings are out on the 10th of November. So what do we have today? Well, I had 9,750 of the D's 2.5 calls trading for a nickel. Again, an interesting trade. Again, an Alex favor where somebody's buying options in an 81-cent stock, which again is a little bit of a head scratcher, unless you're expecting something enormous to happen. Now, the open interest on this particular name was around 13,000 contracts, a little over 13,000 contracts. My sense is that there's probably a buy rider closing. Why you would buy ride a $1 stock, I have no idea. If they were just flat out selling the call naked, again, you're selling calls in a $1 stock. You don't have a whole lot of downside left in a name like this. And looking at the pop today, that just kind of shows you. I mean, the stock this year was in the 52-week range this year. The stock was actually $13.24. So it's bouncing off a low of 41 cents. So just to sell these naked, again, a head scratcher as a trade. Even when a company goes bankrupt, it still takes a while for the stock to go literally to zero and delist. So even selling these things naked was risky. So if they are closing a right, no matter what, they are buying over 9,000 of these things back. So I would check the open interest tomorrow. It'd be interesting to see if this was additive to the open interest. And, maybe the company is experiencing a turnaround. There are a lot of names in this space that are either going bankrupt, like Coco, or they're still surviving. Maybe EDMC is a survivor, and maybe the stock gets back up to $2-3. Who knows? But clearly, somebody's either covering or buying calls, and in either case, they're expecting a little bit more upside. So that is, let's just say, our group of unusual and odd activity. And with that, I'm going to take off one hat, and we will talk to the man with many hats, Mr. Alex Jacobson, on the Xpress Block and the sponsor of our lovely show.
The Xpress Block, brought to you by Options Express by Charles Schwab. Options Express by Charles Schwab lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources. Options Express by Charles Schwab is the online broker for all traders. Best of all, Options Express by Charles Schwab lets you trade stocks, options, and futures all in a single account on powerful yet easy-use trading platforms, including mobile devices. Visit optionsexpress.com for your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, and welcome to the Xpress Block. This is the part of the show where Alex comes down from on high, maybe wearing multiple hats, putting on one, switching in, and putting on another one. It depends. And he will let us know what's going on with all the cool stuff coming out of Options Express from Charles Schwab. Alex, take it away.
Thanks, Andrew. And Andrew and I were actually discussing before the show started. We do kind of a little warm-up with each other. And Andrew was gracious enough to say, why don't you take a couple minutes? You've talked about premium harvesting in the IdeaHub a lot lately. And maybe we could backtrack a little and talk about the methodology behind it. So I'm going to take a couple minutes to do that. We created a product here at Options Express a couple years ago called the IdeaHub. And what they had done even before I got here, the folks who built this company, after running it for a number of years, said we need to generate an idea generation tool. We need to bring people to a sort of fertile marketplace where we can show them a target rich, and target rich is a legal term. And I'll talk a little bit about that. And it's part of the distinction between what would be considered investment advice and what would be considered an idea generation tool. And I know some of you are going to scratch your head and say, well, that sounds like, just parsing compliance language. But the idea was there were two essential threads behind this. Number one, investors come to the marketplace. They come to Options Express every morning, and some of them are longer-term investors, and some of them are very short-term investors. In fact, when the first inkling of this was in the design stage, weeklies were also on the design board, but not out yet. And the concept was, let's give them stuff to look at. So we created this concept called the IdeaHub, and we designed a number of what we affectionately call tiles or strategy areas. And we, in fact, released the first four. Two of them were income-covered call writing and premium harvesting, and two of them were directional, which one was an unusual activity tile looking at trading anomalies in the marketplace, and the other one was looking at earnings. And the tile that's gotten the most traction is premium harvesting. And in fact, that tile has that section went over to Schwab Mobile a week ago, Monday. In fact, I'll be teaching a class tomorrow with the SIBO to a group of Schwab customers, showcasing premium harvesting. But what we did in premium harvesting, what we did initially is we take the volume metrics from the SIBO. Now, Andrew and Mark frequently talk about the VIX and the various VIX products. So just as a quick refresher, VIX is a volatility benchmark of the S&P 500. But also keep in mind, it's also a volatility benchmark for the SPDR, which is also the S&P 500, and the S&P PM, which is the PM settled version of the SPX. The big indexes in the United States, the SPX, the NDX, and the Russell, are AM settled versions. SIBO also has a PM settled version of the SPX. So we took about a dozen of those benchmarks, and they translated into 16 underlying names. So we did this on the SPX, the SPDR, the SPX PM, the Russell, which is the big cash settled version. The ETF is the IWM. And we actually nicknamed them the Sweet 16. And what we do is we take this volatility benchmark, which the CBOE calculates live every minute of every regular session trading day. SIBO now calculates VIX in after hours as well. And we use that benchmark to calculate a 1 standard deviation out of the money credit put spread, credit call spread, initially on those 16 names. So that if you came to the IdeaHub, you could see a 1 standard deviation out credit put spread on the SPX or credit call spread on the SPDR. Probably something a lot of people don't know is SIBO calculates a volatility benchmark on 5 individual equities. And there has been so much traction in this that it actually surprised me. But the CBOE calculates a VIX-like benchmark on Apple, Amazon, Google, Goldman Sachs, and IBM, and Apple is still relevant even though it's the post-split 7-for-1. So what we do is we put up a target-rich environment of credit put spreads, credit call spreads, and iron condors, and that's something I take a lot of pride in. It's the industry's first quantitative iron condor finder, and that way Options Express customers can come to the IdeaHub. Schwab customers can now come and see it on mobile. It will be available on Street Smart Edge and on schwab.com in the coming months as we integrate the Options Express tools and the Schwab tools more. But this is a way to come to see credit put spreads that are based on quantitative decision making. And the ideas will be everything from weeklies, 1 week, 2 week, 3 weeks. We have a filter in there of 25 cents. So if a spread is trading for less than 25 cents, we pull it. We show it on the OX side in the fully customizable all-in-one trade ticket. The reason I bring that up is there are lots of users here at OX who want to customize what we do even more. So they don't want to go out one standard deviation. They want to go out a half standard deviation, or some people want to go out 2 standard deviations. Great, whatever their risk tolerance is. We show it to them and then they can customize it. We give them their starting point. We create the traction in it. As I say, a week ago, we ported it over to Schwab Mobile. A couple months ago, we ported it over to the futures side here in futures options, and it looks at 4 underlying names. It looks at the crude contract, the gold contract, options on the crude, options on the gold, options on the E-mini S&P, and options on the E-mini NASDAQ. It is all quantitative, and I get that question from a lot of people who say, "Well, look, I'm a chartist, or I'm a point and figure person. Can I take what you're putting out and overlay a streaming chart over it?" And the answer is, of course. If your basis for decision making is you're looking for head and shoulders tops, and you want to sell a put spread near a top because you think the market's going to move to a trading range from there, you can overlay your tools for it. If you're a pure fundamental trader, a lot like Mike is, and you're saying to yourself, well, maybe this 2030 level in the SPX is getting near the top. I think the market's going to go into a range of maybe 1990 to 2030 for the next couple of months. You can overlay those tools and find credit strategies that you like. So it's a very cool product. I'm personally very excited because I was on the team that developed it. And let me point out, when I talk about this with a lot of pride, it takes a village, and there is a team of people. There was a team of very talented programmers, a team of very talented graphic design people. Every time I demonstrate this product, everybody looks at the graphic design, and the first question they ask is, "Did you do that?" And I go, "No, I'm just the options guy." But it's a very interesting product. Very excited that it's porting over to the Schwab side now, where it already has significant engagement with customers. I hate to say this because it sounds like I'm bragging, but we've had customers come over from other firms just to get access to the IdeaHub. And if you're a listener and you haven't seen it, come to OptionsExpress.com. You can't see it in the test account. You actually have to open an account, but you got 30 days to fund an account, so you can play with it before you put any real money into it. And as I say, teaching it tomorrow, Friday. Today we're taping on Thursday, teaching it tomorrow to a group at SIBO. Come to OptionsExpress.com and take a look at it. And Andrew, I want to thank you for teeing that up because I always love talking about it.
So, hey, anytime I'm a guest host, I'll tee you up like that, Alex. So my one question for listeners that might understand. So you've got the VIX, you've got the equity indexes, and when you talk about kind of a quantitative, showing you a quantitative approach, is you're basically, is the IdeaHub trying to point out, let's say over spreads that look like overvalued relative to sort of how the vol indexes are trading? Is that sort of how it's set up?
No. It's just, it simply takes the vol metric and says, look, at a 20 vol for a weekly option, being one standard deviation out of the money would be this distance from the current price. Here's a put spread that's one standard deviation out. Here's a call spread that's one standard deviation out. So we take the SIBO vol metric because that gives us the essentially the probability discovery, right? Volatility
Gotcha.
is a way to think of price distribution, and we take that and we say, look, if you're an investor who wants to sell at least one standard deviation out of the money, about a 70% expected success rate, and keep in mind that probabilities change as markets move, as time passes, and as volatility changes. Also keep in mind 6 or 7 weeks ago, you had a pure downdraft in the market, and in those kind of periods, the people who own options are the people who are going to do better than the people who sell options. And that's a little bit of an oversimplification, but we simply take the SIBO benchmark and on a 15-minute rolling basis, calculate stuff on the equity side, at least one standard deviation out of the money. The reason I say at least is sometimes you don't have dollar spreads and stuff, so you've got to, round out to the $5 mark. On the futures side, because our futures clientele is much more aggressive, we go half standard deviation and full standard deviation, but we give them quantitative credit spreads. And some people just take them the way they are. Some people adjust them out. Some people narrow them. Some people have a bias, especially interesting in things like the spider, where maybe we'll come up with an idea and it'll say, sell the 207, 217 credit call spread on instruments over $100. We default to $10 wide spreads. And I've talked to customers who say, I don't like to sell dollar strikes. I'm going to sell the 210. I'm going to take the data that you've provided that gives me sort of the line in the sand of where one standard deviation out is. And I'm going to sell the 210, 215 because that's my view of the market. So we tee up the idea. Many investors take them just the way they are. Many investors adjust them because they want $5 strikes, or they have something else they're overlaying. They think they're near some technical support or resistance. So it's a very cool product.
So it's actually, instead of people just sort of blindly like saying on CNBC or whatever, the VIX is doing this, you're actually taking the VIX and turning it into a useful measure for your clients at OX. A VIX of this means this.
Yeah, and the surprising thing about it for many people is we do it on every SIBO volatility metric, and obviously as the VIX is the one that gets talked about a lot. But as I mentioned, a lot of people don't know there's a VIX on 5 equities. There's a VIX on the NASDAQ, which is also the VIX on the Q. There's a VIX on many of the ETFs, the emerging markets, the Brazil. So we lay up and tee up ideas on all of those. And to your point, Andrew, some people come there and just bang it out. Some people come there and adjust it. Some people come there. The first month I headed up, I did a seminar, and I had somebody on the seminar say, look, I just want to sell the naked strangle. I don't want to do an iron condor. Can I knock out the long legs on the trade ticket? And the answer is sure. If that's your risk profile, you've got a 1 standard deviation out of the money strangle up there. You don't want to sell the iron condor, knock out the long legs. Or if you're less risk averse and you want to sell something like on NASDAQ, which is a $2,000 index, there are people who want to sell $50 wide spreads, just them in the all-in-one trade ticket. So, I keep using the term, it's very cool, but it's very cool.
I think it is very cool. I think it's like I say, it's an approach that we use, at Option Pit, as far as, you have to understand what the market is pricing really first. in order to get a good sense of what you want to do. So it kind of jibes exactly with how I think about selling premium or buying premium for that matter. You got to at least understand the information the market's giving you before you go jump in and go start selling stuff willy-nilly. So it's a great idea.
Yeah, I agree. I think with all option traders, and every time I say this again, I get four hands that go up and two boos. But the real difference between what I'll call a really well-informed option trader and just an ordinary option trader is an ordinary option trader is going to make a trade based on some assumption about direction and some assumption about time. And they're going to be wrong a lot because they didn't factor in. Here's what makes a very well-informed option trader. Their decision-making is based on time, volatility, and direction. And, it's the classic option story. And I used to ask this question every option class I ever taught. How many of you have bought a call, had the stock go up, and the call goes down? And, four hands go up, and then everybody looks around, and then 12 hands go up. And you say, well, what conclusion did you draw? And someone will say, market makers are all felons. And then you get that laugh. And then someone says, the vol changed. And you said, bingo. And that's it. Because when you're trading option, long side, short side, earnings, whatever, what you're essentially trading is the bet on volatility. And if you don't have a sense on volatility, keep in mind you can be wrong, right? We're not always going to be right, but keep in mind you can be wrong. And that sort of tongue-in-cheek question about you bought the call, the stock went up, and the call went down. The preface to that is the day before the stock was down and the vol spiked.
Yep.
And you bought a call that was at twice the vol it was the day before. You came in the next day. You were right. The stock went up, the vol went down, and your call lost money. And that begins the discussion of what should you have done if you thought you're in a declining volatility environment. And people will then say, well, call spreads wash some of the vol out, sell a put. One ironic answer that I use all the time, which sometimes people don't come to, is buy the stock because there's no vol premium in the stock. And a fourth answer is don't trade. Push away, because it's better not to make a trade than it is to make a bad trade.
I like that number. I don't think enough people do that. I think sometimes they try to force something when really there isn't a trade there. But yeah, I think that might be an excellent topic for Mr. Tusa when he gets back for the strategy block on Monday. Hopefully, if he's back to his normal verbosity by then.
Well, we hope he's back.
We hope.
I think this is a testament. Yeah, I think this is a testament to stuff that you and Mark teach, where you really talk about the importance of vol, and this industry pre-VIX really didn't talk about vol unless you spoke to institutions and you talked about vol smiles. And I remember when I was at the SIBO, you take people on the floor, and this is back in the days when market makers had sheets, and they'd show the sheet of the vol smile. And if you had a well-informed customer, they'd start to say, I need that. I need that kind of volatility discussion. I need that kind of volatility tool. And the great thing about the period post-2000 is you had the creation of all these options-centric firms. And you had firms like Options Express who all of a sudden began to build tools that gave you vol, that let you look at implied, let you look at historical, let you search by some of these things. And the traditional pre-2000, pre-multiple list electronic trading of options, e-commerce discount brokerage houses just heard this loud whooshing noise of their option customer leaving to go to an option-centric firm. And what you've seen in the last 5 or 6 years is the option-centric firms have all been bought, the ones with scale, by the pre-2000 option leadership firms. And I'm going to tread a little lightly here because, got to be careful what you say about acquisitions. But, you see Schwab buying OX, You see TD buying Thinkorswim, and that customer who, 1980 when I worked at Merrill Lynch, the small account option customer, Merrill Lynch wasn't that sorry to see that person go, but that customer today is incredibly valuable because they're not a $5,000 account, they're a $300,000 account. And behind that is a $400,000 401k or IRA that they can now trade options in, and in some circumstances do spreads. Schwab will have spreads in IRAs in 2015. That has become one of the most treasured and valuable customers on the street.
Well, yeah, and they're in general, because I'm in the option education business, and we have a lot of those. That's what our customer is for the most part, where they just want to learn how things work so they can go do it by themselves. Where like similar to the IdeaHub, you start to generate an idea based on some theoretical value, relative value, and then they go off and craft the thing they want to do, and that's when your client is kind of off and on their way. Which I think is a good thing. But I think with that, I think we will wrap up I guess I can only call it our extended Xpress Block. I think we can handle a question from the mail block today. So with that, we will close out the Xpress Block and we will roll into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody. Welcome to the Mail Block. I think we have time for one question. And Alex, this is, I think, one of those brain buster questions from one of our listeners, Mukund Ambarge. Okay, this is where it goes. Now, Alex, you're going to have to put your thinking cap on for this. So you're going to have to take off maybe one of your fancier caps and put on whatever a thinking cap looks like for you, which I don't quite know. Maybe it's the Viceroy hat is actually your thinking cap. So anyway, hi team. He said, I had a quick question on Theta. I understand that Delta is in constant flux with every tick or move in the stock. I agree with that for the most part. The Delta/gamma changes. So yes, Delta does move with the underlying, and that Greek is called gamma. So far, so good. Next is implied volatility is in constant flux with the buying and selling of options based on volume. I also will agree with that Vega does change. That implied volatility does change with the buying and selling of options. So Vega changes with option transactions. Now, here's what I would say is Vega is the sensitivity to a change in implied volatility for any option. So to the extent that implied volatility is changing, your Vega will be changing depending on the moneyness of the option. So if an option's kind of at the money, the actual Vega number doesn't change a whole lot. If the option is out of the money, the Vega of the option does change a little bit. Okay, he goes on. But Theta Decay is the only one which is always in a steady pace, i.e. it is not like it will decay quickly today and slowly tomorrow. Now here is, I would just disagree with this a little bit. Theta is sensitive to a change in implied volatility as well. So the higher the volatility is, the more the option will decay, and the lower the implied volatility is, the slower the option will decay. It's just the rate of Theta coming out of the option changes. All right. So his question is now, so the question is when Theta Decay is really adjusted in the prices. So the question is, when is the Theta Decay really adjusted in the prices of options? Do the Theta Decay get adjusted at every tick or move or every hour? Is it adjusted daily? Then when is Theta Decay taken out of options? I think he's talking about early morning before the start of trading, late in the last few minutes of the day is the Theta taken out. Also, I don't know when is weekend Theta taken out of prices. Friday, early morning, middle of the day. Okay, when does the market maker run the prices for the model and set the prices? Basically, he wants to know how the heck all this works. So I can answer that. I can throw it to you, Alex. What do you want to do?
You were a market maker. Talk about how you did it.
So I'll tell you a couple ways. So one is Theta came out of our sheets based on how our model works. So if it ticked away, like when I ran my sheets in the morning, and by the time I ran my sheets in the afternoon, my option essentially decayed on my sheets because I'm running my time forward. So just think of your Theta as a percentage of, a 24-hour period, right? Theta happens all week long, right? Even on the weekends. Now here's kind of the hook. What I just told you is Theta is linked with implied volatility. So if I raise the implied volatility in your options, okay, you have theoretical Theta, as in you expect the Theta to come out of the option, as in, let's say I have $1,000 worth of decay today. If I raise the implied volatility, I'm going to have more Theta today. The problem is when you raise the implied volatility, it kills your option decaying. Because what happens, right? You raise the implied volatility, the option starts expanding in value. And when an option is expanding in value, it's not really decaying. So to the degree that your implied volatility is changing, that's going to set how your decay works. So it's not a total cut and dry answer. Options will decay on some fraction of the day, right? That's just how the model works. You run the model on a time, and essentially just think about this. Every hour, the option gets a little cheaper if all of the inputs to the model stay the same. However, if you start raising the implied volatility while your theoretical decay number grows, you actually don't get it, right? The option is not shrinking, right, making you money. So if you're short that option and you keep jumping the implied volatility up, boop, 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 right, the value of the option keeps expanding. Expanding options can actually decay. Now, the next day they might start decaying, and you might start to capture that. But if the implied volatility goes up even farther, the option decays more, the option expands more, and you're short it, you're not going to collect that decay yet. So you have to wait. You have to wait until the implied volatility stops going up. And then all of a sudden, you're going to have this gigantic influx of Theta, hopefully into your account, showing up as P&L, because all of a sudden you're going to have a big Theta number, and now you can start to collect it. So as a market maker, what I would do is I used to run my sheets usually just 2 days forward, my theoreticals. So today is the 6th, I'd run them on the 8th, pushing my date forward. So I would be like 1 day ahead at the beginning of the week. By like Wednesday, I would run them 2 days ahead, trying to depress the theoretical value of the options to keep me from paying up for options that I knew that were decaying. Everybody does it a little differently. So I've seen, as an index trader, I started to see that decay by like Thursday morning. I could see, right, implied volatility dropping, quote unquote, because I'm pushing the day forward. As you push the day forward, it lowers the value of the options, right? So you have to think of, is the vol coming out because I'm pushing the day forward, or is the value of the option coming out because I'm pushing the day forward, Theta killing the value of the option? Or is it because I'm actually depressing the implied volatility, making the options worth less? But that's the thing with implied volatility. Remember, implied vol is always today's date right now. All right. So depending on whether you are changing your theoretical vol or changing your date, that is going to skew how the quote unquote implied volatility looks. So it's not always a cut and dry answer. So let's say on Thursday, you've pushed your sheets forward a couple of days, you push the value of the option down, but all of a sudden something happens and you let the theoretical volatility you're running in your sheets fly. Now the option's worth a ton, and all of a sudden your implied volatility jumps up, essentially putting the weekend back into the options. But it's the interplay between implied volatility, messing around with Theta, right, based on Vega, right, is how all that works. Now I know it's actually not a very easy question to answer quickly, but that's sort of how it all works. So hopefully I answer that question. And I know we're running out of time, so right here we're going to close out our mail block, and we're going to move into around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, Alex, what's happening at OX this week?
By the way, that was the best explanation of theta and weekend I've ever heard. Kudos to you, and what a terrific opportunity to have a real market maker talk about that. So I'm going to blow warm air up your skirt or whatever but that was terrific. And it's not an easy question to answer, but the way you did it was just outstanding. What's going on? 3 live events, and the first one, Jimmy's on his way up there already. This weekend, Saturday, November 8th, he's in Detroit. Next weekend, he's in Raleigh, North Carolina. Weekend of the 22nd, he's in Houston. These are live events. They're simulcast on the site. So if you can't make it to a live event, or you do want to make it to the live event, come to optionsexpress.com and register. You'll have to register either for the live or the simulcast, but the events are free. And it's great to see that Jimmy is out there now. You know, one thing is when you get some vol in the market, the crowds that come to events they're just bigger. I mean, it's not like you get 5 more people. It's like you get 4 times as many people. Next week, a couple webinars on Monday the 10th. Nina's going to do the trading platform and a tour of the site, talk about some of the new features. And on Tuesday, the 11th, she's going to do streaming charts. What's going on in the world of the pit in the coming week, Andrew?
The world of the pit this weekend, we're going to have using options to trade direction. Very similar, actually, to the IdeaHub, understanding how volatility works to kind of place trades based on volatilities. When the vol's higher, the vol's low, what's sort of the best type of trade to actually get done what you want to get done. And similar to Alex was mentioning, like an overlay. But we show you how to do that, how to read volatility charts, how to understand those vol indexes to help you figure all that stuff out. If you surf on over to optionpit.com/events, you can get a bargain on it. The primer is almost sold out. We expect it to be sold out. And you save $70 by listening to this show and jumping in and grabbing it. And other than that, I guess we're looking at non-farm payrolls and seeing how the week ends up. Oh my gosh, as Tusaw would say, it's never been a better time to sell your holdings in the S&P 500 than it is today.
Your webinar's on Saturday from when to when?
Saturday, 9:30 a.m. To 12:30 a.m. Eastern time.
And how do they navigate to it?
They navigate to it www.optionpit.com/events. And that's how you get there. So help you make heads or tails of all that volatility information. Thanks, Alex. I think that will do it for this episode of the Option Block. Thanks again to my host, co-creator, I guess, of the IdeaHub there at OX, and the major domo here at the Option Block. And for myself, Andrew Giovinazzi, filling in for Mark Longo on the Options Insider Radio Network, I bid you all adieu, and we will see you next week right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.